So, you're looking at the Singapore property market, trying to figure out what's on the horizon. Well, you've come to the right place. Today, we're going to chart a course right through the landscape of 2026. We'll break down exactly what you, as a middle-income family, really need to know to make that next big move. All right, let's just dive right in, because this is the big question on everyone's mind, isn't it? After years of just, crazy price hikes, the market is finally shifting gears. So is this a golden opportunity, or should we be a bit more cautious? Let's get into the data and see what it tells us.
Okay, first things first, let's get a feel for the overall climate. The main theme for 2026 isn't some huge, dramatic change. It's more of a deliberate slowdown. You can almost think of it as the market just catching its breath after a long sprint.
What we're really seeing here is what a lot of analysts are calling a Goldilocks environment. It's not too hot, but it's not too cold either. After that post-pandemic frenzy, the market is finally settling down. And honestly, that's a really healthy sign if you're trying to plan for the long term.
Now this tells a really fascinating story. Just look at the HDB resale growth. It went from a blistering 9.7% in 2024 down to a projected 2 to 5% in 2026. And the private market, it's following a pretty similar path. The key takeaway here isn't that growth is just stopping, but that it's becoming way more sustainable and, importantly, more predictable for all of us.
So what's behind this shift? Well, it really boils down to three key things that are going to directly impact your family's budget. Let's break them down one by one, starting with supply.
This number right here, it's an absolute game changer. In 2026, we're talking about over 13,000 HDB flats reaching their minimum occupation period, or MOP. That's nearly double the number from 2025. For you, as a buyer, this is fantastic news. It means a flood of newer resale flats is about to hit the market, giving you way more choices and a lot more negotiating power.
Now, on the other side of that coin, demand is still incredibly strong, and the main engine driving it? It's the HDB upgrader. See, as HDB resale prices went up, the price gap to get into the private market actually got smaller. This has empowered thousands of families to make that leap, creating this really steady stream of buyers that props up the entire private condo market.
And finally, let's talk about the cost of money. After some pretty nerve-wracking spikes, mortgage rates are expected to settle down right in this range. Now, the era of super cheap loans might be over, but this new stability is huge. It means you can actually plan your budget with some confidence without having to worry about these sudden, massive jumps in your monthly payments.
Okay, you simply can't talk about property in Singapore without talking about government policies. These cooling measures, they're not just a bunch of regulations. They are the fundamental rules of the road, designed to make sure the market stays stable for everyone.
First up is the ABSD. Think of it as a tax that just gets heavier and heavier the more properties you own. So for families out there thinking about a second property for investment, this is a major, major factor. It's built to keep speculative buying in check, and it really highlights why you've got to be so financially prudent in your planning.
Next, you've got the Seller's Stamp Duty, or SSD. This one is all about encouraging a long-term mindset. It's basically a tax you have to pay if you sell your property too quickly after you buy it. The goal is simple: stop people from flipping houses for a quick buck and reward those who are in it for the long haul. And that, of course, adds to the whole market's stability.
And this shows you exactly how it works. The government recently extended this holding period to 4 years. So if you sell in that first year, bam, you pay the highest tax. Sell in year 2, it's a little less, and so on. By the time you hit year 5, it's gone. The government's message here is crystal clear. Stay invested and you'll be rewarded.
All right, so we've covered the market conditions, we've covered the rules. Now for the really fun part. Where are the opportunities hiding? Let's take a look at the areas that are really poised for some serious long-term growth.
This is basically the golden rule of Singapore real estate. Time and time again, the data proves it. Properties near transport hubs, especially MRT stations, they just appreciate faster and hold their value better. It's a simple but incredibly powerful strategy. Invest where the infrastructure is going. And here's the proof in the pudding. A property that's just a walkable distance from an MRT station can fetch a price premium of 10 to 15%. I mean, when you're making one of the biggest financial decisions of your life, that kind of built-in advantage is something you absolutely have to consider. So where should you be looking? Think of this slide as your treasure map. It highlights all the key transformation zones from the URA's master plan. For instance, the Greater Southern Waterfront. That's not just another project, it's a massive redevelopment that's going to be 6 times the size of Marina Bay. Can you imagine the potential? Then you have the Pile of Our airbase, which is set to become a whole new town, where building height restrictions will be lifted, completely changing the skyline. And new MRT lines like the Cross Island Line are going to unlock value in places like Turf City. These are the spots where the next big wave of value is going to be created, so you'll definitely want to keep a very, very close eye on them.
So how do we take all this info and turn it into a real, actionable strategy? Well, this next part is your playbook, and it's tailored specifically for families trying to navigate the 2026 market.
This quote from market analysts really pinpoints a specific tactical window. The first quarter of 2026 could be a real sweet spot. And why is that? Well, it's a combination of sellers who are motivated to get deals done right after the new year, plus those stable, predictable interest rates we were just talking about. It's a moment where all the conditions could really align in your favor as a buyer.
But before we go any further, let's just bust two really common myths. First, the idea of waiting for a big market crash in Singapore. It's a pretty risky game. The country's economic fundamentals are just strong, and the government measures are there to prevent that kind of volatility. Second, please don't assume that your $80,000 kitchen reno is going to add $80,000 to your asking price. It just doesn't work that way. Renovation value is subjective, and frankly, it depreciates. Buyers value space and location way more.
Now pay attention, because if there is one key strategic takeaway from this entire explainer for a middle-income family, this is it. Let's say you have a fixed budget, maybe $1.5 million. The old way of thinking might point you to a shiny new 1- or 2-bedroom condo. But the new mantra for 2026 is this: more bedrooms, not newer ones. Why is this so important? Because a larger, older resale unit targets the single biggest group of future buyers out there, HDB upgraders. And what will they always need? More space for their families. This gives you a much stronger exit strategy down the road, and that is the absolute key to maximizing your investment. And so here we are, right back where we started, but hopefully with a much clearer map in your hands. The market is moderating, interest rates have stabilized, and these new growth areas are coming into focus. So the question now isn't really if you should make a move, it's how. And hopefully, this guide has given you the framework you need to decide which strategic move is the right one for you and your family.